Welcome to Taking Stock for the week ending the 6th of May 2022. Joining me today is our Managing Director and Chief Investment Officer, Tim Lincoln, to stream to you all things share markets. But before we get started, we need to let you know that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Any tables and charts we share is based on historical data and therefore should not be relied upon as a guide for future performance. So Tim, we've seen volatility re-emerge this week, especially in the US, with the Nasdaq down around 5% last night, and both the Dow and S&P 500 down over 3%. And this has been an issue for growth and quality investors. So what are we thinking at the moment?
Yeah, good question, Kien. I'm trying to adopt a really opportunistic mindset. At the end of the day, I always say that volatility creates opportunity, and we've got volatility in spades at the moment. Although, you know, when you see 4 and 5% drops on a night session in the US, it keeps you on your toes, doesn't it? And it really, really does force you to try to think through exactly what should I be doing tactically right now relative to what's going on and what's causing the volatility and where are things at based on the opportunity consideration in the US and here in Australia. So yeah, I'm trying to adopt a really opportunistic but very tactical mindset. So I'm cautiously optimistic. And we'll cover off on some points from, you know, how Warren Buffett and Charlie Munger are thinking on the back of their Berkshire Hathaway meeting last week, you know, some points in a moment. But in the US, so our members and investors, they all know that I've got these trigger points in regard to when I seriously consider deploying more cash into the market. And that's at 10% falls, whether it be the market or stock specific. It's 20, that's when I start to drip feed in. At 20%, I start to get pretty excited. And 30% below highs, I really just start to look under the sofa to see if there's any spare change there so I can invest that into the market as well, sort of getting very, very active. So in the US now, the Nasdaq, which is where the Lincoln US growth funds are certainly more aligned to the performance of the Nasdaq is now down over 20% from its highs. The Dow Jones and the S&P 500 some 15% from their highs. So I'm now today, as we speak, I'm getting very tactical in considering exactly how much money I've got to employ into the US market. The Lincoln US funds, they're down circa 20% from their highs too. So I'm obviously now thinking deeply about that. However, what do I now do in Australia? So the All Ordinaries at the moment and the ASX 20 are down some 3%. So they've been really supported in Australia, even though we are in this increasing inflation, increasing interest rates, lots of geopolitical risk going on around the world. Australia, from a large cap perspective, seems to be quite immune to the volatility that's occurring in the US, only because we're very bank-centric and resource-centric market. And therefore, because of what's going on in the Ukraine and Russia, a lot of our commodity stocks are being supported. And now in a rising interest rate environment, banks are seen to be a bit of a safe haven. So they're really propping up the ASX 20 and also the All Ordinaries, the ASX 200, ASX 300 are being supported by this theme at the moment. On the other end of the scale, though, growth is still being smashed here in Australia. The tech index in Australia is down some 30% from its highs. And the small ordinaries down around 12% from its highs. So that's why Star Growth stocks, they're also down around 10% from their highs. And the Lincoln Australian Growth Funds are down some 15% from their highs. Whereas on the other hand, the Lincoln Australian Income Fund and Star Income stocks are down only around 3 and 4% because they're more closely aligned to the ASX 20 and the All Ords. So in Australia, I'm not getting those same signals across the broader market that I need to get really tactical in employing cash into the Australian market, because it's just so mixed at the moment between larger caps doing okay, but the smaller end of the market, or the tech, or the growth, yeah, they're getting smashed. But I just can't get as excited. Well, it's not excited because it's cautious optimism, as I said, about the Aussie market at the moment. Even though I'm in, and I'm staying there, absolutely staying there. I'm just not getting as tactical with the deployment of cash as I am into the US market because it's fallen now generally across the board. So that's what I'm thinking. Yeah, I've never known an environment though, Kien, where there's been so much macro influence causing volatility for such an extended period of time. And it's just crazy that these quality growth stocks everywhere around the world at the moment are the catalysts for more money flowing into speculative large cap and may not be large cap quality. So it's a very, very strange environment. But at the end of the day, we've got to take advantage when good quality stocks get oversold. We have to be bold and brave and stick to our true philosophies and focus on the long term and believe that our investments will turn out in a really positive way over that long term. But I don't think we're going to see the dynamic growth from any redeployment of cash. I don't think we're going to see, that massive bull run that we've enjoyed over the last 10 years for a while until this rising interest rate, rising inflationary environment, and the things in the Ukraine start to settle down a bit. So I think we'll see more steady growth going forward once things settle down.
Yeah, that's right, Tim. I mean, growth and quality, they've been affected by these interest rate rises, and the issue is many of these growth stocks and quality stocks, their earnings are holding up. They've been reporting quarterly updates, which are quite strong as well, Tim. And just this week, I mean, the US Federal Reserve, they lifted interest rates by about 50 basis points to between about 0.75 to 1%. Its biggest increase in 22 years. So that's creating a lot of fear there. And here in Australia, the RBA has surprised a lot of economists by raising their cash rate by 25 basis points, and now it's around 0.35%. So inflation and interest rate hikes have dampened the demand for growth and quality stocks due to their higher valuation multiples and also due to the larger cash flows into the future. But again, these are where the opportunities lie.
Oh, sure are, Kien, and they're the philosophies we have to stay true to. On the back of the pandemic, we always knew there was going to be inflationary pressures. They just had to be based on stimulus and the ability, wealth was still being created through that environment. So money was always going to flow back into the economy, which pushed prices up. So it was always going to happen, and we couldn't stay at zero interest rates forever. Interest rates had to increase too, but this is now the aftershock of now the moves actually starting to occur. So inflation will remain here for a while. Interest rates will go up, probably normalize around 3 or 4% in the coming years, but it's still a pretty low interest rate relative to history. So uncertainty is a factor we can never eliminate from our investment process, Kien. However, we can minimize misjudgment by remaining disciplined and focused on the long term. That's critical. Markets go through cycles, and history has shown us that quality companies are more likely to outperform over the long term. That's just we see the charts, we see it all with volatility. Cycles are moving against, but over the long term, quality, it's just common sense, really, isn't it? That quality wins out at the end of the day. This is no better exemplified than the successful investment veterans, Warren Buffett and Charlie Munger. As I said before, at their recent Berkshire Hathaway conference, it was comforting to see strong alignment between Berkshire Hathaway's investment philosophies and some of our key takeaways. However, Kien, I don't sit here and profess that I'm a Warren Buffett or a Charlie Munger at all, but I know when Dad first created his PhD and then we applied his principles around measuring financial health based on financial metrics into the investment markets, that there was a close alignment between how we identify a healthy company and a quality company and manage our well-diversified portfolios around that. Very close alignment to the Buffett and Munger philosophies and theories too. So it's lovely, and we've held true to those philosophies forever. But lovely to see that some of the quotes made by Buffett and Munger were, be greedy when others are fearful and fearful when others are greedy. So Berkshire Hathaway, led by Buffett and Munger, they've actually been deploying a lot of cash into the market recently. I think it's come down from some $140 billion So they've been really active in deploying cash into this volatile environment, similar to the way we think. And they believe that market timing is a fool's game. So it's not about being reactionary to the volatility of the market. And when markets fall, you get spooked and you exit the market, and then you try to time your way back in once you believe everything has been over. It's not about that. It's just about investing in quality. And when you see quality getting oversold, that's when you buy. That's the timing perspective relative to the fundamentals of the company, not relative to the volatility of the market. So trying to time the market itself is a fool's game. It's a long-term investment asset class. We know that. Stick to quality stocks. Don't start to invest in companies where inflationary pressures and interest rate pressures based on the debt they hold on their balance sheets become an issue. You don't want to see companies that are unhealthy having to go out there and raise capital in this environment. Raising capital means it's a desperate means of trying to survive in an environment. What you want to see is healthy companies with a war chest, enough cash to be able to get through times of volatility. So really important that our portfolios are quality and contain financially healthy businesses. Be very wary of the speculative environment. There's still, if we looked at some of the spec indexes out there, there's a lot of speckies still doing really, really well in this environment in regard to stock prices. Crazy stuff. Buffett and Munger are highly critical of Bitcoin and cryptocurrency, as I am. You know, it's a real trader's game, that sort of stuff. Again, just bring it back to quality and be very wary of not being attracted to speculative type investments in this environment because they're hot at the moment, which often means we're at the top of the cycle. When the taxi driver gives you tips and you get all those tips at the dinner parties and whatnot, that's when we know we're at top of cycle. So be very wary of speculative investments. And lastly, Kien, and I really support this point as well, Buffett and Munger both believe that index funds and the explosion and dominance of index funds or passive investing is exacerbating problems in the way that index funds just invest in everything. The great companies, the high quality companies, and the unhealthy, highly speculative companies. So when you see the good companies and the poor companies rising together, it really makes it hard to identify where the opportunities are. So index funds, and I think that they're taking up a massive percentage of global markets at the moment. They're exacerbating the problem too. And Buffett really questioned whether the term active fund managers, where they're meant to be good stock pickers, do deep research, but they end up just hugging the market in the form of an index fund. Are they really adding any value to investors? So, in time, I think, the stock picker, the fund manager who's a really strong stock picker, genuine active manager, they'll win out too. But I've got a bit of a dark thought around the problems that index style passive fund managers may cause the market, perhaps in the not too distant future.
Yeah, that's right. That's a great summary, Tim. I mean, during times of volatility, we just got to control our emotions and to really invest in the facts. And that's where our golden rules are important. The facts are clearly there and the framework is there for our investors to make that disciplined and objective decisions, especially during this time. Yeah. But with that in mind, let's turn to our numerous updates over the week with some attention to our star stocks. Now, during the week, borderline star growth stock and star income stock, Janus Henderson Group, they are a global multi-asset fund manager. They were placed under review on the back of rising active risk, Tim. And the stock declined by about 13% after the fund manager provided a first quarter update, which was around 14% below market expectations. And there was a significant rise in fund outflows and weaker market performance, which led to a 23% decline in earnings. Now, despite this, the company was able to increase its dividends by around 2%, and that's taking its payout ratio up a notch.
Yeah, really hard at the moment, Kien, isn't it, in this environment of volatility to get a good read on a fund manager, because they're just exposed to the volatility at the end of the day, and their funds under management, performance fees and whatnot, they go up and down relative to all of that. So it's a really tough environment. So, but the team are actively reviewing the outlook and active risk for Janus Henderson. to see whether it will remain worthy of its star stock status. And under Golden Rule 3, earnings growth is expected to decline by circa 12% this year, and earnings revisions over the last 3 months have continued to move lower. And you can see that under Golden Rule 3 and, of course, under Golden Rule 4 on the little chart there.
Yeah, that's right, Tim. I mean, growth is negative because there's another 7 billion of outflows, roughly equating to around 2% of assets under management. That's scheduled for the remainder of the financial year. So for now, Janus is currently on a forward gross dividend yield of about 5.8%, and it is expected to go ex-dividend pretty soon. But we just got to be mindful that trend, if you're trend sensitive, and you should be sitting on the sidelines, given that it has triggered a negative trend on both the SD Max and SD30 TSR. So just be mindful there. And another stock that has been under pressure is electronics retailer and star income stock, JB Hi-Fi, following its quarterly result, which was pre-guided at the end of March. But we feel the company's negative share price reaction was more a function of the RBA's 25 basis point rate hike, and that's affecting a lot of these retail stocks, Tim.
Yeah, the consumer customer will be tightening their purse string somewhat, Kien. But one thing that sticks out for JB is their free cash flow is expected to decline this year. So what's the reason for this? And could it have an impact on their future dividends and question their sustainability?
Yeah, good note there, Tim. The drop in free cash flow is due to really the timing differences in working capital. And that's for the purchase of inventory. Remember that a lot of these retailers, they are facing a lot of supply constraints, supply chain issues. But we believe the forecast dividend yield of around 7.7%. Now that's achievable given that free cash flow remains well above expected dividends, as you can see on screen, while the payout ratio at around 65%, that's unstretched as well. Remember, the company was able to fund a 250 million off-market share buyback only recently as well, Tim.
Yeah, no, JB Hi-Fi, the wonderful business, but it's a great case study for this environment being a high consumer retail stock. So thanks, Kien, wonderful insights. And on the topic of high interest rates, it's just fascinating how, macro influences and major economic indicators and movements in those can affect stocks at varying levels. And one stock that is really exposed to it is Genworth Mortgage Insurance. And with Genworth's first quarter update, Kien revealed a potential slowdown in new volumes, with gross written premiums down some 25% on the quarter, probably on the back of rising interest rates and fewer mortgages being taken out because of that. Are we concerned about the impact that those rising interest rates will have on demand for the loans and lenders' mortgage insurance going forward?
Yes, Tim, this is an active risk we are closely monitoring at the moment. As you specified, rising interest rates do affect that demand in volumes, but also it can also lead to mortgage stress and a rising claims as well, Tim. However, for now, claim rates are under control, with the unemployment rate also remaining quite low. So we're paying attention to some of these risks as they emerge.
Yep, and if they still have that gold, green or purple star next to them, Kien, that means that you and your team still are very comfortable with their current level of quality. So whether it be from a growth perspective or an income perspective. But keep your eye on that, because the active risks for a company like Genworth are absolutely ever evolving. Interesting too, Kien, their earnings revisions are positive, but I'm sure the team will continue to monitor that as well. The stock on a forward gross dividend yield of 10% and an unstretched payout ratio of 53% also represent really positive signs at the moment for Genworth from an income investing perspective.
Yeah, of course, Tim, but we will be assessing the sustainability of that over the next week. Yeah. But looking at our corporate calendar, for the week ahead, we have our final interim banking result for Westpac this Monday, while CSR, they're likely to release their annual result on Thursday, the 12th of May. Note that both star income stocks, the banks ANZ and National Bank, they've released their first half results and their dividends appear sustainable, with ANZ and National on gross dividend yields of around 7.6% and 6% respectively. We also have several AGMs next week, including Grange Resources, Genworth Mortgages, Smart Group, and Waypoint REIT. So stay tuned for that. And on the technical alerts, for highly trend-sensitive investors utilizing the SD Max, which is the Stock Doctor moving average crossover, we are pleased to see bullish trend changes from BWB Trust, Brambles, and GUD Holdings. Meanwhile, we've got Breville Group, Collins Foods, Infomedia, MA Financial Group, and REA Group. They've all issued an exit signal on the SD30 TSR, which is the Stock Doctor 30% loss from its highs or gains from its lows. This week, we put borderline star growth stock ARB Corp under the microscope. They are an auto parts manufacturer, especially for SUVs and four-wheel drives. Tim, they released a second quarter update, but it wasn't embraced by the market.
No, they've been under a bit of pressure. And look, throughout its time as a star growth stock, and it's been in there for a long time, over the years, all stocks come under pressure at some points in time. And yeah, this is ARB Corp's turn, but it's really on the back of that second quarter update, Kien, and especially the revenue guidance was 4% below what the market was expecting, which really led to the share price volatility in the last few days. So what drove the slowdown, Kien, in sales growth?
Yeah, if you look at the revenue guidance, you'll notice that it's still strong growth in financial year 22, and that's exemplified by Stock Doctor, the Golden Rule 3 on screen. But the market may have been spooked by a potential slowdown in its sales momentum.
And I also know, Kien, under Golden Rule 2, that earnings quality is still regarded as weak. Now we know, and you and your team commented extensively on the reasons for that through increased inventory levels because of supply chain issues on the back of COVID. But are you still worried about their cash generation now that a lot of cash has been absorbed in increasing their inventory levels?
Yeah, that's right, Tim. I mean, the company's weak earnings quality was the result of higher inventory buildup, which had impacted operating cash flows. But judging from management's comments this week, the high inventory levels are anticipated to persist for a little while longer as the group aims to cushion the impact of supply chain bottlenecks. So this could mean that earnings quality could still be impaired in financial year 22. So we'll be monitoring this situation very closely.
Yeah, thanks for that, Kien. And it's always great to see, I love to see skin in the game. And it is great to see the company's founders, the brothers, Andrew and Roger Brown, both hold a significant investment in the company still at 6% of total shares on issue. Although there appears to be a bit of a sell down of around 17% by management over the last 12 months. Is this a concern?
There was a sell down in November 2021, Tim, but this isn't a concern given that they do have a history of these divestments in the past in 2019, 2013, and August 2012. But the wealth it has created for shareholders, it's been significant, and it's okay for them to take some off the table to reward themselves, Tim, especially given that their wage is also quite conservative.
Terrific, Kien. Great answer. Thank you. And ARB share price is now trading at a substantial discount to consensus valuation under Golden Rule 5, Kien, which we see as a bonus of a quality company of this nature. Is this an opportunity for broader investors too?
When we're looking at consensus forecast, Tim, it's likely that over the next couple of days, we're going to see a lot of these analysts pare back their forecasts. But having said that, the fundamentals for this business remain intact. You look at new vehicle sales, that's remaining positive, while the thematic towards larger vehicles and also outdoor activities remain quite elevated following COVID lockdowns.
Terrific, Kien. And I noticed too that there's 9 covering analysts for ARB based on, the broader contributing analysts out there from various research houses. So it's a well-covered stock. So, you can rely on those consensus forecasts quite a bit now, which is terrific. But I also must point out that trend sensitive investors will probably be out of the stock, both the highly trend sensitive, those that use SD Max, and the moderately trend sensitive, those that use SD30 TSR, as both of those indicators have been triggered.
And in the midst of the bank reporting season, and with the RBA now increasing interest rates by 25 basis points, a useful question for income investors today is, how do banks benefit from rising interest rates?
Yeah, it's a good question, isn't it, Kien? And very, very pertinent, obviously, to that rising interest rate environment and, you know, the attractiveness and the defensive or the perceived defensive nature of banks in a volatile share market. But the core of banks' profitability comes from its net interest revenue, which represents the margin the bank generates by charging a premium margin on its loans and relative to the rate it pays on deposits and funding sources. So when cash rates rise, banks will increase rates on their fixed and variable loans, obviously.
Yeah, that's right, Tim. But contrary to popular belief, this isn't where most of the benefit comes from. Rather, the benefit comes in the form of higher returns on so-called replicated portfolios. And these portfolios allow the banks to manage their interest rate risks and are invested in government bonds, which are now paying higher rates, Tim. Also, deposit rates as well in savings accounts, they remain near zero for a while. And this also helps lift overall margins. And last but not least, there's expectations for higher interest rates. They can lead to more expensive fixed loan rates. So customers tend to shift towards the variable rates, which have higher margins as well. For example, ANZ just recently mentioned that the flow towards fixed loans have halved over the last few months.
Yeah, really insightful and interesting, Kien. Thanks for that. And what other stocks potentially can benefit from a rising interest rate environment?
Yeah, that's a good question, Tim. Some of these include, for instance, net wealth, the ASX, and also Medibank Private. Now, both net wealth and ASX, they earn interest on client margin account balances, while Medibank has an investment portfolio that is 80% weighted towards fixed assets, Tim. Anyway, that's all we have time for today. But again, thanks, Tim, for your insights.
Yeah, no worries, Kien. I know it's a long recording today. Dave, our production manager there behind the scenes, gives us an update on time all the way through. So I know it's a long one, but it's an important one. It was a real opportunity for us to share with our members and investors exactly what we're thinking at the moment, Kien. And it's hot in the kitchen, no doubt about that. There's a lot of influences at the moment, and it's just a great opportunity, again, for us to help guide our members as to, you know, how they could be navigating relative to their tolerances to risk, whether they're looking at Australia, whether they're looking at the US, and help get through this time. So yeah, wonderful, Kien, and there'll be further insights shared on Monday morning when yourself, Maddie Schwartz, and Rob Manfrey conduct Lincoln Live. So if you haven't, any members who haven't attended Lincoln Live, I encourage you to do so. That's Monday morning, 10 a.m. Australian Eastern Time. It's really been incredibly popular, and we thank everyone for tuning in. Unfortunately, and I love attending because it's a live session, unfortunately, I can't be there for the next 2 weeks, but it's in great hands with yourself, Kien, Matt, and Robbie.
Yeah, thanks, Tim. And just to remind our investors, in an inflationary environment, we need to focus on those financially healthy, quality companies that can produce a good or service that remains in demand. And similar to Warren Buffett and Charlie Munger, take advantage of those opportunities into quality exposures that have been sold down on the back of interest rate hikes. In the meantime, take care and have a happy, healthy, and prosperous week, everyone.